Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Securitization Explained: Process, Benefits, and the Future. Ever wondered how banks turn your home loan into a tradable asset? Welcome to the world of securitization, where finance meets innovation. This process plays a crucial role in today's financial markets. It involves pooling various types of debt, like mortgages or credit card balances, and selling them as securities to investors. Investors then receive regular income from the repayments on these debts, offering a way to diversify their holdings. For banks, it's a way to free up capital and issue more loans. This boosts the economy by making money more available for businesses and individuals alike. Securitization isn't just a behind-the-scenes financial maneuver, it's a powerful tool that impacts mortgage rates and credit availability. Keep reading to see how this financial technique shapes the market and what it means for you. The securitization process. Ever wonder how banks turn loans into investment opportunities? That's where the securitization process comes in. It's like turning a pile of building blocks into a solid structure that investors can climb on. Let's break down how this fascinating process works. Asset pooling. Think of asset pooling like gathering all the pieces you need for a big jigsaw puzzle. Financial institutions collect various financial assets such as mortgages, car loans, or credit card receivables. These assets might seem ordinary on their own, but when combined, they form a substantial asset pool. By doing this, banks spread the risk and increase the chances of steady returns. Special Purpose Vehicle, SPV, creation. Imagine an SPV as a bridge that connects the asset pool to investors. The bank transfers the pooled assets to this newly created entity called a Special Purpose Vehicle. It's important because it separates the financial assets from the bank's operations. This separation ensures that if the bank faces financial trouble, the SPV and its assets remain unharmed, creating a safe haven for investors. Issuance of securities. Once the SPV is ready, it's time to create securities. Picture these as tickets to an investment event where investors get a slice of the pie. The SPV issues different types of securities, generally in the form of bonds. These securities can differ based on risk and return levels, offering something for everyone from cautious to adventurous investors. Cash flow management. Managing cash flow is like orchestrating a symphony, where each instrument must play its part at the right time. The cash generated from the underlying assets, like monthly mortgage payments, is collected by the SPV. This cash is then distributed to investors in the form of interest and principal payments. The timing and amount of these payments are carefully managed to ensure everyone gets their fair share. By following these steps, banks and financial institutions can transform everyday loans and receivables into attractive investment opportunities. This process not only fuels the financial market but also provides a steady flow of funds, making it a crucial component of today's financial landscape. Types of securitized assets. Securitization might sound complex, but at its core, it's about turning something into a tradable financial product. Think of it like turning a pile of Lego bricks into a fancy model you can show off. Now, let's break down the different colors of those bricks that you can use in the model. These are the securitized assets. Mortgage-backed securities, MBS. Mortgage-backed securities are like the rock stars of the securitization world. These securities are bundles of home loans sold as a single investment. Imagine a giant bag filled with different types of mortgages. When you invest in an MBS, you're essentially buying a piece of that bag. Structure. An MBS is built from a pool of home loans. Mortgage lenders sell these loans to an institution, which then groups them together. This bundle is then turned into a security and sold to investors. Significance. MBS play a major role in providing liquidity in the mortgage market. They allow banks to lend more by freeing up capital. Plus, they offer investors regular income, making them appealing like a reliable old friend. Asset-backed securities, ABS. Asset-backed securities work like MBS but have different building blocks. Instead of mortgages, they're backed by other types of loans. Think of them as a diverse collection of colored blocks that include everything from car loans to credit card debts. Types of assets. ABS can be backed by various items: auto loans, loans people take to buy cars; Credit card receivables, outstanding balances on credit card accounts. Student loans, loans given to students for education. Other types, anything from equipment leases to royalties. These securities allow lenders to convert these debts into cash flow, like a magic trick that turns promises into money. By diversifying the loans, apps help spread the risk among investors. Collateralized debt obligations, CDOs. Collateralized debt obligations take complexity up a notch. If asset-backed securities were colors, CDOs are the complex rainbow. They bundle various loans and debts into a single investment but often include different tranches or slices, each with varying degrees of risk and return. Overview. CDOs package loans like a fancy layer cake with dense flavors. They can include mortgages, bonds, or other debts. Investors choose which layer or tranche they want to invest in based on their taste for risk and reward. Difference from other products. Unlike the straightforward nature of ABS or MBS, CDOs mix different loans, offering diverse slices of risk. It's like betting on a team with multiple stars instead of just one player. This makes them popular but also more complex and sometimes controversial. Each type of securitized asset has its unique flavor and appeal, much like picking different types of ice cream at a sundae bar. Understanding them helps investors decide where to put their resources, balance risk, and make informed decisions in the financial market. Benefits of securitization. Securitization is often seen as a financial wizard's tool, transforming illiquid assets into liquid ones and offering a buffet of benefits to both originators and investors alike. But what exactly makes it such a powerful instrument? Let's break it down and shine a spotlight on the key advantages. Liquidity generation. Imagine sitting on a treasure chest that's inaccessible. That's what it feels like for financial institutions holding loans or mortgages on their books. Securitization unlocks this treasure by allowing these institutions to transform their assets into marketable securities. They can sell these securities to investors, instantly injecting cash into their system. Quick cash flow. By converting loans and receivables into securities, originators get immediate funds. This influx of cash can be used for new ventures, paying off debts, or even expanding operations. Improved cash management. With a steady flow of liquidity, companies can plan better and manage their cash flow with more precision. It's like having a predictable stream of income instead of unpredictable bursts. Risk diversification. Would you put all your eggs in one basket? Investors in the financial world certainly think twice about doing so. Securitization offers a path to spread the risk and achieve a balanced portfolio. Spread across multiple assets. Instead of being tied to the performance of a single asset, investors can engage in a diversified pool. This diminishes the potential impact of any single asset's failure. Tailored risk levels. Different tranches and securitizations cater to varying risk appetites. Investors can choose high-risk, high-return securities or opt for more stable and predictable ones. Cost of capital reduction. For issuers, one of the shining stars of securitization is the potential to lower the overall cost of raising funds. But how does this work? Attractive interest rates. Securitized products often carry higher credit ratings, which can lead to lower interest rates. It's akin to borrowing with a shiny credit score, attracting favorable terms. Increased marketability. By structuring assets into securities, issuers tap into a larger pool of investors. This increased competition among potential buyers can further drive down the cost of capital. Efficient capital use. With reduced costs, capital can be deployed more strategically, fostering growth and innovation without a hefty financial burden. In the financial universe, securitization acts like a transformative catalyst, turning constraints into opportunities for those who understand its mechanics. Risks associated with securitization. Securitization can be a powerful tool for financial growth, but it's not without its risks. Understanding these risks helps businesses and investors make better decisions, safeguarding against potential pitfalls. Let's break down some of the biggest risks you should know about. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.